KSFR News. This is Walkabout James Wearable talking to people in our listening area. Today, I'm in conversation with Mish Schneider, who is a financial advisor with Market Gauge here in Santa Fe. She has also written a book called Plant Your Money Tree, A Guide to Growing Your Wealth. Today, we are talking about the proposed tariffs by our current president, Donald Trump. What would be some possible consequences of those tariffs? Okay, Mish, welcome to the show. And how did you get the name, Mish?
Well, Michelle is my actual name, but I went to work on the Commodities Exchange in New York. I became a member of the exchanges, which means that you have to have a badge, and you could only have 4 letters. So first it started M-I-C-H, and people were calling me Mick, and I'm like, no. So then I changed it to M-I-S-H, Mish, and it kind of stuck, and that's what I've been called ever since, and I love it.
Well, we're here today to talk about tariffs, aren't we?
That is definitely the word of the 2025.
And how do you define a tariff? What is a tariff?
Well, simply put, it's a tax. What he wants to do is make sure these countries pay the tax that's imposed on them through the United States on the goods that are imported here. The idea in and of itself is not new. It's been going on since like 1780, I think, were the first tariffs.
All countries have tariffs.
All countries have tariffs. And basically, if they're going to say 10% tariffs on China, essentially that's 10% of whatever the cost of the good is added as the tax.
Foreign import sales tax.
Exactly. So if we buy something that's $10 from China and we have a 10% tariff, we tack on $1. And so it becomes $11 for the good that was selling for 10. However, our trade deficit, which means how much we import versus export, has always been for a very long time in favor of the fact that we import more than we actually export. And so that is why President Trump is so fixated on trying to correct that, or at least switch that ratio to we export more than we import.
Well, Trump is always interested in multiple things. He's been using tariffs as a part of foreign policy, correct? Like with Mexico and Colombia as examples. And I also believe that, and Trump has said it numerous times, he sees it as a source of tax revenue.
Yes, this is all part of some kind of master plan, which on paper means that if we can get income from tariffs, things that are being imported into the country, we can possibly lower taxes for American citizens, like the income tax. And they've been throwing around the table eliminating all income tax and just having taxes on things that we consume.
I was listening to one podcast saying that if we eliminated the income tax, we would, and we still kept the same amount of imports, we'd have to pay 70% tax on imports to cover our expenses.
Right. Well, that's why I say there's the idealistic way, and then there's the reality. And the reality is that, we like cheap goods in this country. Interestingly enough, Walmart, which just reported its earnings, right? And we know Walmart's doing very well. No one's going to cry for the Waltons. But they did put a warning out to consumers for the rest of 2025 that their costs would have to go up on their imported goods because of tariffs. And who's going to pay for those costs? Of course, we, the consumers. Tax. Well, technically, the country is supposed to pay that tax. I mean, again, let's talk about ideals versus reality. Idealistically, if you charge countries more to import, they pay the tax and the costs of the goods stay the same in the U.S. But we know that's not the reality. The reality is that these companies don't want to pay more for these goods, and the countries are going to find loopholes on paying those tariffs, which is another conversation. Talk about tariffs now when it comes to particularly technology, which is really where China comes in, which, by the way, to date is the only tariff that has been implemented. The rest right now is rhetoric. But with China, we've already gone 10% tariffs on electronics. So that's anything that you buy that's computer related. So in that situation, the, again, ideal situation is that increases innovation in the U.S. because now we want to compete with China in a way where we can create software and hardware at a cheaper level. Everything that I've been talking about on the media lately has been, let's put the blinders a little bit to the rhetoric and just watch the consumer habits, because that's really going to tell us all, right? The consumer is 70% of the gross domestic product. If the consumer gives it up, like you say, without competition and without the ability to buy cheaper goods, we could go into a major recession, and that's why you're hearing economists start to use that R scary word right now.
Okay, well, a lot of this is speculation because we actually, as you said, we don't know. There's a lot of uncertainty in people's minds.
And markets hate uncertainty. That's sort of a classic rule of the stock market. And then after that, we've got biotechnology, interestingly enough. Because biotechnology, we need our pharmaceuticals. And the most recent announcement, by the way, going back to tariffs, was that there would be a tariff on drugs that are imported from other countries. So that's a concern people have, because a lot of people are using things that come from Israel, Canada, right, Europe, Mexico, right. Well, cars, we'll get into that.
Okay, so let's get back to tariffs. You've given a good background of businesses and the complexity of business. For those listeners who have just turned into this conversation with Mish Schneider, a financial advisor with Market Gauge here in Santa Fe, we're talking about tariffs. A lot of this is going to be what ifs, because we don't know.
We don't know.
But let's just take his proposed 25% increase on steel and aluminum, whether it's 15% or 25%, we don't know, but it'll be some type of likely increase.
So we get a lot of our steel and aluminum from Mexico and Canada, right?
Correct.
Okay, so that's the big thing.
And Brazil.
And Brazil, right. So a lot of economists are thinking, since most cars are made from steel, their chassis, their body, and then aluminum would be the parts, car prices could go up by $3,000. Steel and aluminum are huge in terms of being impacted. However, what Trump, again, going back, is trying to hope is that even if the car costs go up in terms of the imported cars, that we make more cars here. Well, that's not really going to help us, because we aren't huge producers of steel. We have the capability, but we don't do it enough.
Okay, so there's a tariff. And we've talked a little bit about the purpose of tariffs. There's some, we are trying to help increase the profits of some industry. In this case, it'd be the steel and aluminum makers here in the United States. But from what I've heard, we only make about 25% of our aluminum and steel here in the United States, something like that.
Yes. Right now, basically, we have Hyundai Steel that we use a lot of steel from, and they're talking about building a plant in the U.S. To be able to avoid tariffs. So, you've got the American Iron and Steel Institute and the Steel Manufacturers Association. They're in the United States, and of course, they're all for these tariffs because it would help their industry. But again, there's the ideal. I'm going to say this over and over. There's the idealistic side, and the reality side is who's going to work, how much wages do you have to pay, how quickly can this infrastructure grow, and then, of course, the cost of goods to build infrastructure in and of itself is going up. Lumber is at a 3-month high right now. All of this could be a big house of cards and a big nothing, and all of this could go away, and we could just go back to life as usual. Or it could be they don't care, which they've already stated, by the way. And I know I'm going a little off topic, but it's important for people to understand the rhetoric. Bissett, who is our Treasury Secretary, and President Trump have both said, well, prices could go up for a while, but it'll be worth it. What does that mean? For how long do we have to endure that? What's going to be the fallout? And will it actually be worth it at the end of the day?
Well, the reality is that even if you're building a new steel plant, by the time it comes to actually producing steel and hiring workers, we're probably talking about a 3 to 4 year window. At least.
Yes. So there you go. So I guess, without trying to confuse everybody, I think the big thing people should be doing now is prepare for higher prices.
I've heard Trump say that in 1870 we generated all of our revenue via tariffs, or the vast majority of it via tariffs. Things were a lot simpler back in 1870. We also had a lot more natural resources to extract. Now Canada is a major national.
Our 51st state.
Our 51st. There's people have speculated he's just really after Canada's natural resources, which we've no longer able to extract as much from our country because we've gone through those natural resources already. We need to talk about supply chain. Why do we get so many parts in other countries? Why don't we make it all right here?
It's cheaper. I mean, we certainly have a lot of lumber in this country, but we're getting a lot of lumber from Canada.
Because it's cheaper.
It's cheaper, right. And getting back. So that's why. I mean, as long as things are cheaper to get them, and that means companies can run more efficiently because they don't have to pass that cost on, and consumers are happy. Consumer, consumer, consumer. That's where it's at. So now we're going to set that whole apple cart. And again, ideally, we can do all of this here. But we can't do oil here, by the way. Not the way it's been promised. The factor. The other big factor is deglobalization. So, on one side of the glass, being half full is, yes, let's become more independent. We certainly have the resources. We have great borders, 2 oceans, Mexico and Canada. I mean, you can't get better borders than that. But that also implies a deglobalization, and we're already getting into a trade war with the European Union. Is that good for us or not good for us? So that's another megatrend to keep an eye on. All of these things, we don't really know what the end result is. But what we do know right now is we're heading into more of a stagflation.
We'll come to that in just a little bit.
Okay.
Let's just talk about the supply chain. So we're getting things from other countries. Sometimes they eventually may get assembled here, or maybe they may get assembled in Canada. Canada makes a lot of cars that get imported to the United States.
Well, let's bring it even home or closer to that. Let's talk about our iPhones, right? So yes, they're not assembled here. They're assembled in China and sent here. So there's been a lot of talk about what's going to happen to the costs of phones. But if we're going to talk about supply chain, I think you have to talk about the pinnacle example of when people first heard about supply chain. And that, of course, would have to go back to COVID, right? So what we saw in COVID was classic, right? Economies shut down. Everything stopped getting shipped. And so once you had that quagmire of nothing getting through, nothing being delivered, nobody working the docks, et cetera, I mean, there was some people, of course, because they had to keep things moving, but it was so slowed down. And then to distribute them into stores, and stores to have inventory, they couldn't keep enough. And they had low inventory up until that point because to keep costs higher.
Just-in-time manufacturing, which is based on no supply chain disruptions, and most American manufacturers rely on just-in-time to keep their inventories low so that it reduces their total production cost because they don't have as much capital tied up in inventory.
Absolutely. Perfect way to explain it, because getting back to COVID, we saw it go amok. So eventually opened up and everything got better, and there was more supply chain, and inventory exceeded again, and cost of goods started to go back down. But we're having a very similar impact in that because people are anticipating the tariffs to raise the cost, people are starting to stockpile and hoard.
Which is anti-just-in-time.
Anti-just-in-time, and again, will put a stress on supply chain. And I know I haven't seen as much here in Santa Fe, but I know in some places, I've heard from other people who live in other places in the country, that they're already starting to see shelves empty in supermarkets in certain goods.
Interesting.
Until you get to a price point where people can't afford, like eggs, and then
we know eggs are in short supply because of bird flu, but
right.
that has nothing to do with tariffs.
That has nothing to do with tariffs, no.
One of the things that happens is retaliatory tariffs. So China has done what in retaliation? Well,
China has also now put on tariffs on anything coming from America, number one. But number two, is they want to trade with other countries. You see, this gets back to that megatrend of deglobalization. So China is trading more with the Middle East. China is trading with Russia.
South America.
South America. Oh, well, it's so interesting about China because they don't think like the United States. They don't think like one day at a time. They think years, decades in advance. But even like a little country like Jamaica, which we like to go vacation at, the reason why Jamaica is starting to get roads and better infrastructure is because the Chinese have already bought most of the sugar, most of the coffee, and in return...
They have aluminum too there.
Yes, and in return, what are they doing? They're making it so that they can get around Jamaica without falling into potholes.
We just got back from Colombia, and they talked about the Chinese there. They're not excited about the Chinese, but the Chinese are helping to build a huge port in Peru to facilitate South American trade, and Peru has a lot of rare earth minerals.
Right. Right. Well, yeah. I mean, by the way, in Jamaica, they had the Kingston was a great big port that got destroyed in an earthquake.
Yeah.
Right. Guess who rebuilt it?
China.
Of course.
We actually have an interesting thing, and we'll find out because we don't know, but we have a country that's applying globalistic trade policies versus a country that's providing deglobalization trade policies. But then we also have to look at what is Canada doing now? They haven't, there's only the threat of tariffs, but what is Canada doing to manage the potential risks of tariffs?
Well, they also are talking about retaliatory tariffs. But with Canada, let's talk about oil.
Yes.
Because this is another one of those.
It's a supply chain issue.
It's a supply chain issue, and then there's the idealistic versus the realistic. So one of the notions about drill, baby, drill is that we can just, throw the drills on, pull up all this oil from the oceans and from areas like New Mexico, for example.
Yes.
Yeah. However, our refineries, which means the companies that actually take that oil and then refine them into product that we use and put in our cars and warm our homes with, do not have the capacity to do more than 18 million barrels a day. And of that 18 million barrels a day, and that's the whole country, by the way, shale oil is only a small part of it. We do not have the refinery capacity to refine oil that's made in the U.S. or pulled up in the U.S., which is why we go to Canada. A lot of our Canadian oil is able to be refined. So...
Hold it. Just let me get this straight. So the heavy oil that's produced in Canada comes to the United States oil refineries.
Yes.
And then the oil that's produced in the United States goes to the Canadian refineries?
I don't know whether it's the Canadian refineries, but I do believe that we do have to export that oil to be refined. Yes, if you look at the information on the trade deficits, that's one of it. They're saying that U.S. is one of the largest, if not the largest, exporting country of oil.
Correct.
This is why we can't use it here.
Hold it. This is crazy. If there's tariffs, that means it gets taxed 10% with the oil that we produce because it's refined elsewhere to come back into the United States. And if we get Canadian heavy oil, it gets taxed 10% to get refined in the United States. So by definition, oil prices will have to go up.
They already are. And more than that, companies are saying, we're not going to spend billions and billions of dollars in increasing our refining capacity to shale oil, which is essentially what we have.
Well, nobody wants an oil refinery in their backyard.
Well, that's number one. And number two is these companies don't want to spend money on what they see as an eventual dying industry. And there's that. Talk about controversy. There are people say oil will be around forever. Oil will be in demand forever. And then you have other countries and other economists who say no. And like probably, well, first of all, we used to say down on the commodities exchange about oil, how many dinosaurs were there, right?
Okay, yeah, right.
But because there is going to be at some point a limited supply. We know
it costs a lot of money to build an oil refinery, and you want it to go for 50 to 100 years.
Again, so let's go back. I mean, idealistically, we get through this. Prices don't last that higher that much longer. Maybe some of the stances on oil versus EV and versus alternative energy soften. In reality, one would think Elon Musk certainly is in favor of alt energy and not necessarily oil and gas. And things calm down, and we do actually get a surge in that our trade deficit starts to flip, where we actually import less and export more.
All right. So let me summarize this. So we've talked a lot about different things. So we've talked about tariffs and what they are, and we've talked about retaliatory tariffs. They're going to happen. We just don't know how much. Where our biggest trade partners are Mexico and Canada. So anything that hits Canada and Mexico is going to be awful. And it could, depending on the retaliatory tariffs, it could be bad the other direction. So we could be in as you called it, a stagflation economy.
Or it could turn out that, in the game of chess.
Eventually,
right.
Maybe 2 or 3 years out,
Right.
it'll be just fine. Yeah.
Or it may go nowhere because the like I said, cooler heads prevail and retaliatory tariffs. And when the realization is that we can't not sustain those levels of costs to people, and we sought to get pushback by lobbyists in particular, it could all go away.
It could.
It could.
It could. We just, that's the uncertainty. And I think probably one of the biggest takeaways we talked about is that we now have a model of a sector of the world that's running towards globalization, embracing it where the United States used to be.
Right.
And we have the United States going into
Deglobalization.
And we honestly don't know which is going to win and which is going to lose, so to speak, as if there's winners and losers. But there is now an alternative model out there, and we'll find out in 3 or 4 years which model seems to be working better.
For KSFR News, this is Walkabout James Werble talking to people in our listening area. I've been talking with Mish Schneider from Market Gauge, a financial advising firm here in Santa Fe. Tariffs are very complicated. Furthermore, this conversation was recorded in mid-February when there were only tariffs on China. Circumstances may have changed, which would have altered the conversation we would have had today. I hope you found this information useful.